Let's talk about valuations. We have reached valuation levels that, according to a lot of analysts, have never been seen before. The numbers themselves are true. We have not reached valuations like this for as far as I can remember. And the discussion here is, what should we do with that? How should we think about it? What are the conclusions? This is the Not Even Wrong podcast. It's November 25th, 2020. This is Krim Delco. For the day, the fund is up 12%. The market is roughly flat. For the year, we're up 302.5%. The market is up 12%. We're outperforming by 200.5%. The main driver today was Tesla in particular, and also a little bit of the CRISPR index has done very well. Today, we've seen some extreme moves in software stocks driven by a potential buyout by Slack through Salesforce.com. Slack itself is up by 40%. We've seen stocks like Palantir up 30%, Shopify up 10%. Anything software is up through the roof. Tesla is in that club. Clearly, at this point, Tesla's trading something around 16 times sales. Enormous valuation for a company that, of course, has a huge software component. And then I would argue is very similar to Palantir in a way that it's not just a software company, but it's also a company that is combining software as a service together with hardware, and that is very unique. It's delivering software to components or sectors that haven't been benefiting from software before. But let's talk generally about valuations. So what's going on? We're looking at valuations. Valuations are things like price-earnings ratios, price-to-sales ratios, price to EBITDA, EV to EBITDA. So those are the kinds of metrics that the street has been using ever since we as investors have been in the markets, which is something like maybe since the mid-80s, something like that. And of course, those valuation matrices are anything but exact. I would say they're a little bit like, let's say if you're, it's hard to say. It's not like, let's say, a map. It's not like temperature. It's not like your height. It's more maybe, I could compare it to something like Surfline giving you a sense for what the waves will be today on the beach. So you get numbers like 6 feet, 8 feet. You get typically the way Surfline, at least a free version works, is they will tell you today's fair, poor, fair to poor, things like that. So they give you a sense for what's going on, and it's pretty good. So you check Surfline. I think you have a good idea what you can expect today on the beach, but it's by no means exact in a way that, oh, you're going to have 4.5 feet waves and the lineup will be exactly 30 meters away from the beach, and the tide is this, and it's not like that, at least not the free version. And honestly, I don't know if it's even possible to be more exact. So what I'm trying to say here is, if you look at valuations, if you look at, let's say, price to sales, right? It's not giving you anything but a number that is comparable to other companies, and even more importantly, it's comparable historically. And here's already the flaw. Comparable with other companies, well, at Orange Capital, we have our 4 books, our principal stacks, based on pretty much anything but comparability, anything but analogy, anything but that. Particularly 0 to 1, one of the 4 books of our principal stack, is very adamant about uniqueness, about this is your particular contribution to the business, to the world. You are unique, you're a monopoly of yourself, and therefore you cannot be compared with pretty much anybody else. This is the way we think about the world, and this is our approach to generating wealth. So we're not a fund that is, let's say, trying to arbitrage things. We're not a fund that is looking at comparisons and then trying to make sense out of it. We're not like that. We're not judging that by any way, by the way. There are people who do that. And I don't know what their track record is, but people try to do all kinds of things in the markets. We're just not those types of people. So we don't look at historical data. We don't look at these valuation matrices as an indicator for us to think about should we buy or sell a stock. I've discussed this in previous episodes. Our degree of freedom when it comes to investing is the answer to the question, what's next? What should we put our capital to work in next? This is our degree of freedom. So we have no other degree of freedom. We don't think we have any ability to time investments. We don't think that we can play around with buy now and then sell after earnings and then buy it again. None of that stuff. We just believe that typically we can invest and then we have to meticulously make sure we correct errors. What that means is that we are very careful about being right. And if we're right, we just stay invested and that's it. So we have a Popperian way coming from the beginning of Infinity, one of the 4 books in our principal stacks, which is the best way to find what to invest in is not to actually find the investment, but to have a process in place that corrects errors fast and cheaply. This is the key. Because if we can correct fast enough, we will end up with a Tesla or an Amazon or an Apple. Sooner or later we will. We're not that stupid. We will find that company that will generate us the kind of wealth that we're supposed to generate according to our mission. The key is to have an error correcting process in place. And I hope that we have that at Orange Capital Partners. So this is just to get back to the degrees of freedom. And part of the error correction process is to use our principal stack and to meticulously test against the principal stack. This is the key. It's not to test valuations. That's not part of our error correction process. It's not part of our error correction process. We look at valuations in ways that people might look at, let's say, temperature, or like I said, the waves on the beach. Well, it's interesting. Today the waves are high. Should I go surf or not? Honestly, it's not a decision. I'm still going to go take a look. I'm still going to actually try it out. But it's an interesting piece of information. So this is kind of how the way we think about it. But let's get back to the point here. The point is, so what is the degree of freedom here? Valuations are not part of it. So are they irrelevant? The answer is yes. They are irrelevant because we don't control it. We don't control it. And I think there's a massive fallacy in the market when it comes to that, because you can have people say, well, you bought the stock, it's way too expensive, and look, you lost money. That might be factually true. The stock was bought, it was trading relatively expensive given those matrices, and you lost money. So all these 3 things could be right, but I would argue here that there is never, ever a reason for losing money because you bought something expensive. The reason you lose money is because the company that you bought has not been performing according to your expectations. So what I'm trying to say here is the real test is not the valuation. The real test is always, what are my assumptions? What is the competitive dynamic? For example, if I buy a company because I think they can grow, then I have to, in our case, there is no better way than to use our principal stack. I have to test, is this company delivering a unique monopolistic product? Is this company going to be able to grow the kind of growth rate that it's promising? In fact, even more than that. Why? And most importantly, and this is the innovator's dilemma, what is the competitive dynamic? We always get enamored by charismatic entrepreneurs, by people that have really a good idea with a good execution, a great team. All these things can work out well, but what's the competitive landscape? Where do we stand as far as competition is concerned? This often gets overlooked. So all these things have to be in place. Let me give you an example. Years ago, we invested in Apple. I think Apple is a fantastic company when it comes to applying our principal stack. It has a unique product, vertically integrated product, huge market, a phenomenal execution, no competition. everything is working for Apple. They still had problems. This was probably 8 years ago or so. What happened? They had competition, or, well, people thought they have competition. Companies like Xiaomi and others, Samsung, all of a sudden came out of the woodwork, and supposedly they were a threat to Apple. Well, the stock suffered for a while. Because also it wasn't just that people thought, oh, there's competition. Actually, the numbers started to decelerate. And then you put that together, fear of competition, decelerating numbers, well, that's bad for the stock. This can happen. But let me tell you something. This happens to companies with very, very cheap valuations and very expensive valuation. If a company can't deliver, the valuation is irrelevant. And I can attest that. We have a company in our portfolio which trades dirt cheap, Intel, very high dividend yield, very, very low price to earnings, price to sales, all these things. Still, the stock is a disaster. Disaster. Why? Because they're not delivering. The company has a problem on the business front. And this is the degree of freedom. This is what we believe you should always be looking at. What is the business like? Forget valuations. Valuations are driven by macro factors, interest rates, things like that. They are important. I think macro calls are important. Don't get me wrong. It's just not something we do. Sometimes we do it. Right now, we don't think it's very interesting because the macro call is one way. The macro call is save the world, print money, low interest rates, zero interest rates. We're going to become a Japan. The US is going to become a Japan on steroids. This is our call. It's been like that since the COVID crisis hit, even before that, but with the COVID crisis, much more accelerated. So from that perspective, we're done. We're not going to spend more time on macro. So when people show us charts about valuations relative to this, relative to that, when they show us how gold is performing relative to the dollar and the dollar relative to the euro, and these are all nice things, but irrelevant for our wealth generation purposes. These are nice things, but irrelevant for our wealth generation purposes. They might be relevant for other people. They might be relevant even for people that do similar things like us, but they're not relevant to us because we believe that our degree of freedom is concentrated on finding the companies that fit our principal stack, in particular companies that have a unique monopolistic product with a huge growth perspective because they are phenomenal at what they do. They have the best people, the best management, and they have huge markets and the ability to surprise even themselves in how well they're doing. So this is in a nutshell what we control. And the way we test for that is through error correction. That means we constantly test. Is Tesla winning in the marketplace? Are they delivering on their battery front? We've discussed several times how we believe the Tesla story is still very much hardware in terms of battery, drivetrain, and battery management software. We believe the software side of it is almost an additional icing on the cake, a huge icing on the cake, but because there's absolutely no competition. And in fact, the CEO of Volkswagen has said that last week, Herbert Diess, that's where they're lagging. They don't have that, and nobody has that. Nobody, even NIO, nobody has that kind of software capability inside a car, delivering a software as a service product. So I don't want to make this now about Tesla, but my point is we're not concerned about the software side. We're not concerned about the energy side. We are relentlessly focused on making sure Tesla has a lead on the car side because this is still a very important part of our thesis. We discussed Twist Bioscience yesterday, our third largest position, a very large position in our CRISPR index, and the main contributor for our high 20% delivery of the CRISPR index delivery to the portfolio. Why? Because Twist has this disruptive power, as we discussed yesterday. We are going to relentlessly error correct in a sense that we want to make sure that our views on this company stay within what we're expecting. Now, we're not going to be precise and correct about this all the time, but we can be pretty good at assessing if we're way off or not. So that's where we are putting our expertise and our energy and not on the valuation side. So in summary, I think the valuation, again, it's a macro call. It can influence your portfolio. It can influence our portfolio. I've mentioned several times the purpose of this podcast is to give people a sense for what it feels like to run a hedge fund. So here is a big lesson. Focus on what you think you are good at. Focus on your own monopoly of yourself. If you think you're good at macro stuff, then do macro stuff. Then don't call yourself a disruptive innovation fund. You're something else. But if you want to do something along the lines of generating wealth by investing in disruptive technologies, you cannot control macro. It's not part of your degrees of freedom. Take the macro as it is. It can hurt you. If we have a 200-300 basis point rise in the treasury yield, in particular the real treasury yield, that will hurt anybody's portfolio. In fact, even the shorts will lose money. Yeah, if you have a turmoil like that, this is the equivalent of an earthquake in San Francisco. It will just throw everything out of whack. It will hurt you, but that's not part of your control. It's not. You can't spend energy on things you can't control. I mean, this is something you should be telling your 10-year-old son or daughter. But still, a lot of people, they get caught in the day-to-day business. They have this illusion of control. They have this necessity to talk to clients about, well, we have this under control, we have that under control. When in reality, you don't. And it's fine to say that. Now, I'm going to not digress even more, but of course, we have a problem of experts and we don't trust experts anymore. And COVID has shown us how we're very disappointed about experts in the field of health. And I think the problem is always the same. It's okay not to know things. It's okay not to be in control of things. What's not okay is not to admit it. And in the hedge fund business, I hate to break it to you, but you don't have the luxury to go in front of people and talk and throw acronyms and do and this and that, because you are measured by returns. And the returns don't lie. The returns don't lie. And the best way to deliver the returns that your mission is promising yourself and your customers is to stick with your principles, with whatever you believe is your principle stack. Stick with that. If it doesn't work, fix it. But don't get caught in things you can't control. And valuations are a macro call. They are not part of a fund that is driven, like our fund, by disruptive innovation and wealth creation. Thank you.